what's the answer to that question? Do you de-risk in 2022, and what parts might you de-risk?
So we think the construct for equities remains positive. When you sort of look at the market, people obviously refer to S&P 500 index, which continues to sort of hover close to highs. But when you basically look at everything underneath and everything outside of S&P, you have already seen a pretty heavy dose of de-risking. Last I looked, when you look at the median and the average stock within S&P, peak to trough, it's down 15, 16, 17, 18%. And the drawdown has been happening now for over 30, close to 60 days. And when you look outside of the U.S., international markets, EM markets, I would say the situation is already pretty de-risked. So I think it's really the mega caps in the U.S., the top 10 stocks that are holding the ground here. And I think one of the reasons for that is because just simply lack of alternatives. People don't want to go into bonds. And there is still the system is pretty much flush with cash. They don't want to touch high beta stocks. They've de-risked already a decent amount. So they just go into sort of the call it the bond proxies, the mega caps that generally have relatively decent fundamentals. Valuations are not as crazy, and they have pretty healthy capital return to them. So that's kind of, I think, the backdrop. I don't think you can just look at S&P and sort of say market is at highs. You got to look at everything else around it.
How bumpy is the ride going to be in 2022, do you think? There's going to be a lot of things to think about. We're going to have to figure out more precisely what the Fed is going to do. There's certainly risk, it seems, to the upside that the Fed is going to be more aggressive. As we figure that out, where do you think volatility is going to be?
So look, I think that volatility between now and probably end of 1Q will be on the higher side because everybody's sort of looking at what the Fed is going to do. We basically need to see how inflation comes in. And so I think, there's going to be high vol and there's going to be a bit of a roller coaster ride. But I think if you sort of cut through all of that, just given where expectations are, I would ask the question, where will there be the bigger surprise? Is the bigger surprise going to come from Fed being even more aggressive than what's being priced in at this point? Or could the basically Fed surprise of being somewhat more balanced?
Let's talk about Omicron and how that feeds into the whole thing. So we're getting more restrictions globally, whether it's travel restrictions, work from home restrictions. What does that do? Is that a growth story or an inflationary story? Because that's going to directly impact the market rhetoric around the Fed.
So as far as the latest variant goes, again, we don't want to get ahead of ourselves, but from all the data and all the analysis we've done, we don't think it's going to really alter the outlook in any sort of significant way. Could you get a bit of a delay in the demand cycle and so forth? Absolutely. But I don't think it changes the outlook in any meaningful way. Transmissibility is high. Severity from everything we continue to see seems to suggest it's not worse than the prior waves. And we do have still the vaccines, we have boosters, and we have antivirals that I think should help basically put a floor underneath this issue. So we don't think Omicron is that big of an issue. At this point, we really think it's primarily around the Fed and how aggressively the Fed moves.
What is retail doing right now? And I'm not talking about bricks and mortar, I'm talking about retail investors. What is their perception of risk? When you think about this market, it has changed this year. Retail has become a force to think about if you are a professional investor. Do you think retail investors are going to be as aggressive next year when they look at this market? They've got a whole range of other things to think about. You've got a bumpy crypto story. You've got high gas prices. The list just goes on. And then you factor in rising interest rates as well. Just in terms of the supports for the market, kind of where do you see the fragility?
So I think that, look, retail plays an important role. Retail, equity allocation has gone up. But I think on a sort of, so I think for retail to become a risk, you would really need to see a pretty significant unwind in financial markets. You would need to see, if the crypto space completely collapses, that's a risk, but again, I think retail participation within equities, from everything we're seeing based on our internal models, tends to be very much so theme specific, stock specific, rather than necessarily just broad-based, equities. And so, where does retail go next year? Retail, I think you look at a job market, it's healthy. You look at balance sheets of retail, it's probably the best it's been in probably a decade or two. You look at savings, they're still there, excess savings. So question is just, does retail have power to basically step in further? Probably yes, but I think a lot of it is a function of sentiment. And so, I just don't see retail really stepping out in any meaningful way unless the market completely sort of starts to roll over and some of these other, call it, areas such as crypto roll over, at the same time.
So as long as like YOLO and FOMO and the retail guys, as long as all of that remains true, what do you buy in a dip?
What I would be buying at a dip right now is just simply put high beta stocks. They've sold off quite aggressively over the last 8 to 9 months. People right now are basically paying back to close to record premium for low beta and safety and low vol. So what do I mean by high beta? I mean, high beta within cyclicals. I think the travel theme has an exceptionally attractive risk reward for 2022. The travel theme, no reason why summer of 22 won't be better than summer of 21 or summer of 2020. And yet these stocks are basically trading back, many of them, to June levels of last year. Energy theme, I think, is phenomenal. Very attractive risk reward as cross-border activity continues to normalize. And then I think on the growth side, there's a lot of fire sale. And there's a lot of very attractive high beta opportunities there. I mean, just look at a lot of these speculative growth names. They're down 30, 40, 50% from highs. So I would be looking at high beta on both sides of the barbell. That's where I think the most attractive opportunity is going into the first half of next year.
Dubravko, does the high dollar, does the strong dollar, which we may see as we see policy divergence, keep US money in Europe? The performance difference for a US investor investing in Europe versus a Euro investor investing in Europe is absolutely enormous at the moment. It works the other way around. European stocks, European investors getting a good ride. Just sort of geographically, when you think about how you want to invest next year, how big a factor, how big an FX factor should I be thinking about when I talk about my portfolio?
So FX plays a role, but again, I think you really need to see a big move in FX for that to make a big difference. So again, for the dollar, you would probably need to see a 4, 5, 6% move rather than just sort of a 1 or 2% move. And so I think within emerging markets, yes, it's played a very big role. Within, I think, Europe, it's played some role, but less so. I think EM is the bigger one. Look, we think that as you think about 2022, in line with sort of this high beta thesis, we think Europe within the developed space and we think emerging markets within a global context both possess attractive risk reward. And one of the centerpieces, obviously, is China, which has been in a deleveraging mode for the last 12 plus months. And we're definitely seeing signs of pivoting there, which we think should persist as we go into next year. So again, S&P 500 US happens to be very concentrated, very sort of heavy in terms of mega caps. We think it's time to sort of diversify.
Okay, we're going to get to China in just a moment, but one last quick question on Europe. Does the money leave the U.S. and go to Europe? Where does the money flow out of if you're going to take on that beta?
So I think where you could basically see the money flow out of is the mega caps. It's basically, that's where all the money has been going. You're basically seeing record concentration, globally in 30 plus years. So I think that in the first half of next year, assuming inflation basically shows signs of normalization, which we think it will, assuming the Fed ends up being somewhat more balanced and doesn't just continue to basically aggressively move forward with tightening, which I believe the market is pricing in, but it still remains a big question mark. And assuming that the COVID situation starts to come back under control, and I know we're dealing with a lot of headlines now, I do think that you get a rotation from, like I said, lower beta mega caps, where all the money has basically been funneled into higher beta, which includes both higher beta within the US, but includes higher beta abroad, which is Europe and parts of EM.